Hello and welcome to this episode on accounts and audits as governed in the Companies Act 2013. To discuss these provisions, we have with us the benefit of the company of two senior chartered accountants. To my left is Mr. S.C. Vasudeva and to his left is Mr. Kishan Kant Tulshan. Let me begin by asking you about this new authority that's been created under the Companies Act, the National Financial Reporting Authority. What is this authority about? How is it constituted? What is its role?
See, the National Financial Reporting Authority is, of course, a new concept which has been introduced in the Companies Act 2013. This body is envisaged in the Act to make recommendations for the formulations and laying down of the accounting and auditing standards for its adoption by the class of companies and by auditors. And also to monitor and enforce the compliance of the standards, auditing standards, to oversee the quality of the performance of the auditors with regard to the compliance with the auditing standards and the accounting standards. And also then it has a very major power that it can also investigate either suo motu or on a reference made by the central government the professional or other misconduct by a member or the firm, as the case may be, committed by the chartered accountants who are registered with the Institute of Chartered Accountant under the Chartered Accountant Act 1949.
Right.
Once this power is taken up by the this authority, no other authority will initiate any action on this aspect.
Right. So this is also a disciplinary authority.
This disciplinary authority.
And if a disciplinary action is initiated by the NFRA, disciplinary action by, say, the ICAI will merge into this.
You can say, since
this is the sole disciplining authority.
Yeah, this will become this. Once they start with this,
right,
the any other authority will not have any powers to initiate action.
Right.
On that aspect. Right. It has also been given the same powers as the powers of the civil court under Code of Civil Procedures 1908 while trying a suit with regard to the discovery and production of books and other documents at such place and at such time as may be required by NFRA. It also has the powers to enforce attendance of the witnesses. It also has the powers to issue commissions for the examination of witnesses and the documents.
Right. The usual powers of the civil court given to regulators.
Right. Their all powers have been given to them. And in case the chartered accountant is found, or you can say that the fault is proved against him, professional misconduct or other misconduct, then they have the powers to impose penalty to the extent of, if it is individual, to the extent of 1 lakh rupees and 5 times the amount of fee. If it is a firm, then it is 10 lakhs and which may extend to 10 times the amount of fee.
Right.
They also have the powers to debar the firm and the member from practicing as a chartered accountant for a period of not less than 6 months and not more than 10 years.
Right.
This is the sort of power. The constitution is that there will be a chairperson of the authority who would be a person of eminence, having an expertise in accountancy, auditing, finance or law, and it will have members, such members who not exceeding 15, full-time or part-time, as may be appointed by the central government.
Right. So would it be fair to say that disciplinary action in relation to auditors, chartered accountants who review corporate books, has just moved from peer level discipline to a statutory disciplinary action?
It's not only the disciplinary aspect,
right.
Even the overseeing aspect of the compliance with the accounting and auditing standards
right.
has moved to them.
Right.
We have a body as peer review board in our institute, which is comprised of certain peers who are given training on this aspect. That aspect is also going to be covered by NFRA. Apart from that, NFRA would also have, supersedes the powers which are there with the Quality Review Board, which is part of the Act of the Institute of Chartered Accountants Act 1949, which was amended later on in 2005 or say. And this is also, the same provisions are contained in the other acts also.
Right.
In the sense that the Institute of Company Secretaries as well as the Institute of Cost Accountants Act.
Right.
So as far as the chartered accountants are concerned, this power has been taken over
by the NFRA.
NFRA.
So how do we reconcile the roles of ICAI and NFRA? Who does what now?
As far as the disciplinary power is concerned, once they have taken it up, the institute cannot take it up. The disciplinary powers are contained in the Act of the Chartered Accountant Act 1949. So those powers still remain.
Right.
They will still continue with it. But supposing there is a conflict in the sense that this particular authority takes it up,
right.
then
that will be abated. Right.
So that is how you will have to reconcile the two.
Right, right. Tulshan, would you like to supplement some of this?
I would like to add, as far as proceedings against professionals are concerned, NFRA can only take it up on suo motu, on its own motion, or on a reference made by a central government.
Right.
So if as an individual or anybody else, etc., wants to proceed against a professional, initially he has to proceed before the institute. That is one thing. Second is, as far as proceedings against CAs are concerned, there is an appellate authority also. So in case a professional feels aggrieved with the orders of the NFRA,
right.
he can appeal before the appellate authority, which will have a chairperson plus 2 members.
Right.
And as far as constitution is concerned, NFRA will be based at Delhi, and it will have offices at such places. So and further, the annual report with respect to the appellate authority and the functioning of NFRA will need to be submitted to the central government, and they will need to be placed before the both houses of parliament.
Right.
So there is a regulatory mechanism which has been there as far as legislation is concerned. So they will need to report to the central government what exactly has happened as far as they are concerned.
Right.
But in a sense, it is true, the disciplinary proceedings, the peer review mechanism, one can say has moved from the institute to the NFRA.
So accounting standards will be prescribed by the government, recommended by ICAI, in consultation with NFRA, but the disciplinary action and the peer review and any of the powers that NFRA has now been given, if exercised, that is the sole disciplining authority. So there could still be cases where the NFRA may not be interested in disciplining, but the ICAI may discipline those cases.
It can be possible.
That is possible.
Even for that matter, the position with regard to the quality review board and the peer review board is still not clear. I mean, as far as those aspects are concerned, they still remain there. What would be the position? I think the time will.
Right, and legislation and policy.
As we proceed, as the act is put into application,
right,
things would become slightly clear.
Sure.
How they will be implemented, which part will be taken by which particular authority.
Right.
Is something which we'll have to.
Sure.
And one important thing which needs to be kept in mind is about the composition of the NFRA. Because as far as institute is concerned, whether it is chartered accountant, whether it is company secretary, whenever there is a peer review and wherever there is a disciplinary body, a person who is reviewing you or a person who is looking into the proceeding, etc., is also a fellow professional.
Right.
So he understands.
The peer. That's what I meant by
peer review.
So in case the composition is of say somebody else, of say engineers, other things, etc., they may not be able to understand the intricacies. Because accounts are based on opinion. Right. It is my opinion against your opinion based on evaluation of certain circumstantial items.
Right. Therefore, care should be taken
to
ensure that the NFRA constituents are financially literate and accounting literate, if we may use that phrase. So, can we go to a related issue?
I just wanted to add, sorry I am interrupting you. With regard to the professional misconduct and other misconduct, I just wanted to add that this would be as per the definition which is contained in the Institute of Chartered Accountants.
Right. The Chartered Accountants.
Right. Because that act defines what is the professional misconduct. It does not exactly define the other misconduct, but there are so many cases with regard thereto which go on to define what is other misconduct, and those aspects have been taken care of by stating in this section itself.
Cross-reference.
Cross-reference.
Right. So I thought we could move into another area of internal audit. The Act now deals with empowering the government to prescribe where internal audit should take place. So could you elaborate on what those provisions are and how it would work?
The relevant provisions are contained in the rules. Every listed company whose paid up share capital exceeds rupees 10 crores, company which has got borrowings from banks, financial institutions exceeding rupees 25 crores, or companies which have public deposits in excess of rupees 25 crores, they need to appoint an internal auditor.
And the rules can dynamically keep changing.
Yeah.
So anyone covered by the rules has to have an internal audit.
Yeah. Out here there is a observation which I would like to make. The Act is not absolutely clear who this internal auditor will be.
Right.
Presently the inference is the internal auditor has to be a chartered accountant in practice or a cost accountant or any other professional. Now there could be cases, and there are cases where there are large companies and they have got huge internal audit department which are headed by a professional.
Right.
Now whether these companies will be required to appoint an external internal auditor or a firm of internal auditors needs to be made much more clear.
Right. Can we also then, in a related manner, talk about this whole aspect of rotation? Because one of the areas of a lot of discussion when this act was even in a bill form was about should auditors be rotated, how often should they be rotated, what is that degree of length of time that causes legislative discomfort with an auditors association with a company he audits. So can we have your perspective on that?
I would like to start with one small line, and I'll request Mr. Vasudeva to talk about it. In our audit, we have to do a risk assessment, and one of the risk is the familiarity risk.
Right.
So I think the rotation of auditors has come from this particular aspect of familiarity risk. So government is intention is to avoid or take care of this familiarity risk through a system of rotation.
Right.
So as far as provisions
So
are
familiarity
concerned,
does not breed contempt.
yeah, absolutely. So I'll request Mr. Vasudeva to talk
See,
about
the
provisions.
rotation part is that today the appointment of auditors is provided for by section 224 of the Companies Act 56. Now the present position is that you have auditor from year to year, in the sense that he is appointed from conclusion of one general meeting to the conclusion of another general meeting.
Right.
The section which is now being changed brings in the concept of having, in case it is an individual auditor, his appointment is for a period of 5 years. In case it is a firm, his appointment can be for a period of 10 years. After a period of 10 years or 5 years, as the case may be, the rotation would take place. The gap between the two appointments, that means a person who was auditor, say for first 5 years or 10 years, or the firm was there for 10 years, as I said, his appointment cannot be made for a period of 5 years. That means there has to be a gap
Cooling
of 5
off
years,
of
cooling of 5 years. The rules which have come, draft rules. Now, therefore, these rules had to specify the class of companies to which these provisions would apply.
Right. So unless rules actually say that rotation applies, it doesn't uniformly apply to all companies.
No, yeah, it says the section
because we've
says.
tried not to go too much into rules in these videos.
Okay.
Because it
But
then
this
deals
is
the
an-
shelf
this,
life.
this
Yeah,
is
but
an
please,
important rule
that's
which
right,
I
yeah.
just wanted you
Sure,
to
sure.
bring to your light, because it is something dealing with the rotation aspect.
Right. And it discloses the legislative intent, yeah.
intent. The rule which has come, it says that the listed companies, apart from the listed companies, small companies and one-person companies, all other companies will be covered for the purpose of rotation.
Right. So pretty much.
So that is
The
an
whole
important,
gamut,
that the
yeah.
whole gambit is covered.
Yeah.
So if you have a very large number of private limited companies, those will also get covered on the basis of the draft rules which have been now prescribed.
Right. What are the conflicting perspectives on this? I mean, if we can talk through a bit on the whole range of emotions and perspectives around this. I know it's a very emotive subject for professionals. Some say that too frequent a rotation in fact leads to prospect of fraud, because a person familiar with the company's processes has been auditing. Now someone comes in and learns everything all over again, learns the controls all over again, and fraud can take place. The others say familiarity really makes you soften your cynicism, and the auditor's cynicism erodes if you stay there forever. Where does the two get reconciled, and what's your perspective on this?
I would like to speak on this. The section also says, in case of a firm, the auditor or the partner who is looking after the audit also needs to be rotated after 4 years.
Right.
So in a firm of chartered accountants, there are many partners, and a particular client is assigned to a partner.
Right.
And that partner takes care of that particular client. After 4 years, and in most of the firms, the partners are rotated after 4 years. So there is a rotation which is happening
Within those 10 years.
within those 10 years. And if we look at the firm and the law, it means that there will be, in case a firm is appointed for a period of 10 years, 2 consecutive terms of 5 years, there will be 3 auditors.
Right.
First 4 years, 1 auditor, second 4 year, another auditor, last 2 years, there will be another auditor. So the provisions could still be made where there is a firm of chartered accountants. and the partners are rotated every 4 years, there need not be any rotation of the firm, because in case you look at the other way, in case you are an individual, you can be appointed for a period of 5 years, then there will be a cooling period of 5 years, and again you can be reappointed.
The counter to that would be that if a different partner in the same firm taking over is as good as rotation, then there shouldn't be a risk of fraud owing to rotation if a new firm comes in, addressing only the familiarity aspect of it.
I would like to add to what Mr. Tulsian said. You see, one of the requirements of taking up an audit under the auditing standards is that the auditor has to be independent. He has to ensure his independence.
As a standard.
As a standard. It's required. I mean, it's something which is obligatory on his part to see that he is independent. Apart from that, rotation which is now brought in by the Act with regard to the partners' rotation within that period, that also is provided by the auditing standard which deals with the conduct of the audit. It says, and it's a requirement which the institute has adopted as a standard, that the partners will be rotated after a period of 5 years or 4 years, whatever the terms are. Therefore, the issue with regard to the rotation of partners, even if it was not there within the Act, it would have been there by virtue of the standards. Because those standards, in any case, even if they are NFRA also looks into those standards, they would be approved because they are based on an international practices, and I don't think international practices would be changed by any chance in this regard. So, as far as this rotation part is concerned, the emotions are running high because the fact is that the issue of rotation has come up because of some reasons, whatever be the reasons. There was another committee, earlier committee which was appointed, that also did not suggest the rotation. It only suggested the rotation of partners. But it seems the government feels that it may possibly help the economic situation, which they possibly think is on account of the chartered accountants. For that matter, the Satyam case is one of the major reasons for bringing in this. Sorry, I am little bit deviating that why this provision has come, but that is one of the reasons which has brought in this aspect. So the emotions are that there is going to be a large fallout of the auditors if the private companies are also covered, as I said. Just consider the number of companies. I don't exactly know the number, but as far as my memory goes, it's not less than 8 lakhs. And the operative companies being 5 lakhs in the, let's take that way, that 5 lakhs are operative companies.
And how many practicing auditors?
The practicing chartered accountant would not be more than 1 lakh. So how would you do it?
Is there also a cap on the number of audits one auditor can do?
Yeah, it is. Now the one partner can only do 20 companies.
20 companies.
Yeah. There earlier the requirement was that 20 companies did not include private limited companies. Now it takes into account everything. So that is also there. So coupled with that,
so there is a churn. There is going to be things are going to change quite a bit.
So I believe there will be huge professional opportunities for the professionals. I'm not looking at rotation as a threat. It's
an opportunity.
It is a professional opportunities for fellow brothers, but I think the step is slightly premature. Government, I hope, must have done its homework It is not based on one or few isolated cases. Recently, around a year back, an amendment has been made in the listing agreement where the listed companies are required to file their annual accounts with SEBI. Now the report has to be filed either in Form A or Form B. In Form A, those companies will file their annual reports where the report is clean, but they are not qualified or just contains an emphasis of matter which is not a modification to the report. And Form B has to be filed in those cases where the report is modified or qualified.
Right.
So I believe SEBI has established a mechanism where it is going to monitor how the audit reports are framed and do they contain any qualification or not.
Right.
Recently, I conducted a personal study on the qualification in the auditor's report, and I was also under the impression, frankly speaking, and I'll admit, that audit report are perhaps not being qualified. I found over 40% of the audit report are being qualified.
Okay.
So I think the issue is not from the auditor's perspective, issue is from a regulatory perspective.
I'd like to
auditors have reported to the shareholders, auditors have reported to the members, auditors have reported to the registrar of companies, but they have failed to initiate the actions.
Right. I'd like to quickly go into two other areas. One is about the revision of financial statements. The Act now does recognize that if the board believes that accounts need to be revised, it could. I mean, I'd like you to give a professional, thorough review of what these provisions are and how that works. And another related point before going into that, related to what we were just discussing earlier, what does the Act do to provision of non-audit related services by the same economic enterprise which is doing the audit?
As far as the, I'll take your second question first. As far as that part is concerned, they have now said that you cannot take up a number of activities which are, like management work, book writing, even with regard to the your information systems, management systems, all those things are, these cannot be taken up either by the auditing firm or any connected company.
Okay.
So therefore, the
any
affiliated sort of company or firm or whatever it is, those aspects are taken care of by a specific section in the Companies Act. The only thing which has been left out is to be, which can be done is the tax service, I suppose, which earlier when the bill came, it was not very clear, but now the section does not contain that aspect. There are certain other provisions where the shareholding by the partner or by any relative of the partner is also prohibited to be acquired by if he is an auditor of a company.
Right.
So to that extent, we have prohibitions which have been provided.
Right. Now if you can go into the revision of accounts.
Now revision of account, there are two sections which are there. One section is that the revision can be ordered by the when the government puts in an application to a court, competent court or the tribunal, and it is of the opinion that the accounts have been either not been, there have been fraudulent aspects in the accounts, or the affairs have been mismanaged and the reliance cannot be placed on the accounts. They can apply to the court of competent jurisdiction or the tribunal. In that, the central government, SEBI, income tax authorities or any other regulatory body is covered, or any person concerned, they are also covered. So they can apply, and when the order is so made, the accounts can be recast and the accounts can be reopened and financial statements can be recast.
Right.
In respect of a particular year. Then there is a position with regard to the voluntary reopening of accounts, where it appears to the board or to the directors rather, the word terminology is it appears to the directors that the accounts which have been prepared do not comply with the accounting standards
with benefit of hindsight, I mean, they having approved
that
accounts.
is the language I am
Right.
using. That's the language. I would not like to comment what would be hindsight or not, but the language is, it appears to the directors that the accounts are
Not true and fair.
true and fair. They don't exhibit the true and fair view. They are not complying with the accounting standards, or they are not in the form or forms as prescribed in schedule. I think schedule 3.
It is schedule 2 now.
Right,
schedule.
as-
Whatever the schedule.
Yeah.
So in the schedule, and they do not they are not in accordance with that schedule, then the application can be made to the tribunal for the reopening, and the accounts can be reopened subject to the order by the tribunal.
Right.
And the order of the tribunal has to be filed with the registrar of companies.
Right.
These are the two main features I
Main
have given
features
you.
of the act.
Act.
So you wanted to say something on this?
I think the entire accounting and the auditing thing is more focused now on the fraudulent part.
Right.
And as far as companies are concerned and the auditors and other things are, I think they can be, there is a particular hierarchy. There is a management, which is chief executive officers, financial officers, other thing, etc. Then there is a governance part, which is board of directors. Somewhere the poor auditor comes in.
Now, what happens in a
Then we-
situation where
Absolutely.
the board comes to a view that the accounts do not reflect a true and fair view, but these accounts have already been audited. Now, it will always be a question of fact. The auditor will also have to perhaps withdraw his certificate and say no one should rely on it. But the auditor would be forced to ask the management, why did you present to me the accounts that you did, and what's changed that is making you do this view? And then comes the question of whether the auditor was diligent enough in asking the right questions on the earlier set of numbers. Is that a correct summary of issues at hand?
Well, I'll try to answer that, and I think the answer is perhaps yes. We have an auditing standard where we talk about subsequent events. When the accounts have been finalized, issued, circulated, in case the auditor comes across a fact or come across something in subsequent years where he feels the account needs to be recast, the auditing standard requires him to contact the management, and at times requires him to withdraw his auditor's report. And there are a particular procedure how he can withdraw the auditor's report and other things, etc.
Right.
So the auditing standards already prescribe a methodology where the auditor come across a fraud. Now, another is where the auditor has not come across a fraud, the management has come across a fraud,
Right.
where it is a voluntary reopening of the accounts. In case the board of directors or the governing body comes to a conclusion that the auditor's report or the financial statements are not presented as per the requirements of the act, option before them is to approach the tribunal.
Right.
And the tribunal will issue notice to the income tax authorities and other regulators, and will then pass a order for the revision of accounts.
It will have to hear all parties concerned, because the problematic area will be, for example, let's say a joint venture or a family company where two factions have a fight, and one faction says in the board that the accounts are actually not true and therefore need to be revised and therefore approach a tribunal. So there will be an adjudication of whether it is indeed true and fair, and then about whether the auditor indeed applied the correct audit standards effectively.
Absolutely.
Right? That's
It can happen.
That
It
can happen. Right.
It can happen.
Okay.
Because
I think before we wind up, I'd like to talk about one last aspect which is important. It's about reporting of a fraud by the auditor. Like in the course of auditing, you discover a fraud. What does the law require an auditor to do?
In case the auditor come across a fraud, he has to take a call whether it's a fraud which is happening on a regular basis or whether the fraud is material. Now, what is material is a matter of judgment, but fortunately that has been defined in the rules. Material means 5% of your revenue or 2% of your net profits. So, if there is a fraud, fraud could be understatement of profits and it could be overstatement of profits both,
right,
or understatement of liabilities or overstatement of assets, etc. So, in case the auditor come across a fraud where if has and that amount exceeds 5% of the turnover or 2% of the net profits,
right,
within 30 days he has to report that particular fraud to the central government with a CC to the company.
right. So, it's a bit like a cognizable offense. I mean, you report it to the government straight away, not just to your client.
It has to be reported to the government.
Reported to the government and the audit committee.
Right,
Yeah.
to the audit.
And also, I'll just add to what Mr. Tulsian has said, that it has to be 5% or 2% of the preceding preceding year.
Right,
That is the basis.
right.
Not the current year, you may not
Yeah,
be
you
able
still
to.
don't know.
You
Yeah,
still don't
that's
know.
right, right.
And also the position is that the language used in this section is he has reason to believe. Now this aspect again will have some legal
That's right. It'll have to be interpreted as some
interpreted
kind of
because
what standard?
section 147 of the Income Tax Act also uses
A reasonable man's reason to
no,
believe.
it also uses almost
Right.
a similar language.
Right,
So maybe those decided cases come
Will
to
apply here.
Will apply.
right,
But it's a very dicey
right.
terminology.
It'll have to be dealt with.
Yeah.
So, accounts and audit represent such a fascinating subject. We can talk for an entire day, but I'm afraid we've run out of time for this episode. Thank you very much for sharing your insights and perspectives. That's all we have time for this episode on accounts and audit. We're very grateful to the two panelists for sharing their thoughts and insights. We'd urge the viewer to review the provisions. The idea of this video is to only give you a nodding acquaintance with the requirements of law. Thank you very much for watching.